Let's get back to the BNN top line conversation. Even with today's losses, the TSX closing out a year worth remembering. The composite index is on pace for its best year since 2009. To weigh in on this, we're joined by David Burrows, President and Chief Investment Strategist at Barometer Capital Management. Always great to see you, David.
Great to be here.
So we may have not have entered this year thinking that Toronto was going to be the winner of the North American markets, and it's a pretty good run. What have you seen that bought us here, and can we sustain it into 2017?
Right. So the thing that strikes me off the bat is how quickly things can change. You know, people get stuck in a view, and clearly coming into February of this year, we were on the back of about 16, 17 months of very weak markets, particularly in Canada, or any country that was a resource producer, or frankly, any country that had significant exposure to China. Because in the fall of 2014, things really sort of came off the rails with growth in China, and anything associated was impacted. So it's interesting, when we entered this year, if you had taken a survey of what people wanted to own, it was defensive positioning, things that were tied to interest rates, because of course rates were going to be low forever. And interestingly, if you look at the flows through the course of the year, despite the fact the market basically has been rallying since February, the flows were most significantly into bonds, in equities, most significantly into emerging markets. Despite the fact that really what worked was developed markets like Canada and the US and Europe now, and some of the sectors that are most economically sensitive. So it's been a tough year for a lot of portfolio managers and a lot of investors because they really had to shift their stance and shift their view as to what might be coming.
Now, you mentioned the bond market. Obviously, we saw a big change after Donald Trump took the White House, a sell-off in bonds, and suddenly interest rates, despite the conventional wisdom, did start moving higher. What do the technicals tell you right now when you look at fixed income?
So look, as somebody once said, you have to trade the market you have, not the one you want to have or expect. And interestingly, in June of this year, really rates started to back up then, well before the election. And the most economically sensitive groups, like materials and like industrials and like financials, started to outperform on a relative basis. So what I would say is we are coming into year end with some very clear trends in place. Now, there's some rearranging of the deck chairs in the last few days. That's some profit taking and rearranging. You can't get caught up in that. There's very clear leadership in financial services, in industrials, in energy. These are all things that make up a big part of the Canadian market. So I would say that as we exit this year, despite a bit of profit taking, when you look at history, if you have a positive trend coming into the end of the year, in 70% of the cases, January, February wind up being solid. So I think that you don't want to fade this. There's a lot of people who want to say, look, too far, too fast. And you have to remember that the market is a forward-looking vehicle. And what may be coming starts to get priced in now before you actually see it in the numbers. So I would say in general, market is moving towards economically sensitive stocks, and probably flows will start or have started to come away from the bond market. So rates I don't think are rocketing from here, but I do think that it's likely that over the course of the year, rates can continue to tick a little higher, and the defensive stocks sort of underperform, and the more economically sensitive groups can continue to outperform.
When you mention equity markets being forward-looking, does it help explain why, when I look at the TSX composite, I'm looking at a price to earnings 23 times earnings.
Right.
Looking at the S&P, I think we're at about 21. Some people feel that's a little rich from where we are right now.
And so you have to remember that a PE is made up of two things. It's made up of price and the earnings estimate, right? Now, think about the last few years. We've had lots of disappointments from a growth perspective. And so analysts have learned that it's very dangerous to guess at what might be coming if things are getting better.
So you think maybe they're lowballing the E part of that equation?
I think that they have been schooled to the point where they're saying, I'm not going to start raising my estimates until I see concrete evidence. Now, at the end of the day, we have to weigh the odds. It's likely, for instance, in the US, we're going to have some changes on the tax front. We're going to have some changes on repatriation of currency held overseas. We're going to see some deregulation. And all of those things are highly likely to have an impact. And we have been seeing earnings estimates go higher since September. specifically in a few groups. So I do think that they're very cautious, but I do think you're likely to see estimates go higher.
As far as oil goes and the help that it's given us this year, getting above $50 and holding now in the mid $50 range, can we count on that in through 2017? I mean, the 2017 should be the year that OPEC puts the deal into place.
Yeah, and so I think that if I were to look at the key themes in this market, I would say the most investable theme is financials and industrials. They could have some legs. They're under-owned. They continue to be under-owned. The difficulty with energy is that it may be more of a trade than a long-term investment theme, because we know they can put new production into place very, very quickly using the new technologies. There is capital available to these companies, and there's some really low-cost finders in the U.S. that really aren't bound by the OPEC agreement. So I do think that there's some upside, and we do have some positions on in more growth-oriented, low-cost producers. The nice thing is there's all these other sectors and themes that we can focus in. We're in a market that's broadening. More and more stocks are participating, more and more sectors are participating, and that can go on for a long time.
All right, David, don't go anywhere. We're going to hold on to you and continue the conversation.